Part 1. Corporate Governance. Many annual meetings are a waste of time, both for shareholders and for management. Sometimes that is true because management is reluctant to open up on matters of business substance. More often, a non-productive session is the fault of shareholder participants who are more concerned about their own moment on the stage than they are about the affairs of the corporation. What should be a forum for business discussion becomes a forum for theatrics, spleen venting, and advocacy of issues. The deal is irresistible. For the price of one share, you get to tell a captive audience your ideas as to how the world should be run. Under such circumstances, the quality of the meeting often deteriorates from year to year as the antics of those interested in themselves discourage attendance by those interested in the business. Berkshire's meetings are a different story. The number of shareholders attending grows a bit each year, and we have yet to experience a silly question or an ego-inspired commentary. Instead, we get a wide variety of thoughtful questions about the business. Because the annual meeting is the time and place for these, Charlie and I are happy to answer all of them, no matter how long it takes. We cannot, however, respond to written or phone questions at other times of the year. One person at a time reporting is a poor use of management time in a company with thousands of shareholders. The only business matters that are off limits at the annual meeting are those about which candor might cost our company real money. Our activities in securities would be the main example. A. Full and fair disclosure. At Berkshire, full reporting means giving you the information that we would wish you to give us if our positions were reversed. What Charlie and I would want under that circumstance would be all the important facts about current operations as well as the CEO's frank view of the long-term economic characteristics of the business. We would expect both a lot of financial details and a discussion of any significant data we would need to interpret what was presented. When Charlie and I read reports, we have no interest in pictures of personnel, plants, or product. Reference to EBITDA make us shudder. Does management think the tooth fairy pays for capital expenditures? We're very suspicious of accounting methodology that is vague or unclear, since too often that means management wishes to hide something. And we don't want to read messages that a public relations department or consultant has turned out. Instead, we expect the company's CEO to explain in his or her own words what's happening. For us, fair reporting means getting information to our 300,000 partners simultaneously, or as close to that as possible. We therefore put our annual and quarterly financials on the internet between the close of the market on a Friday and the following Monday. By doing that, shareholders and other interested investors have timely access to these important releases and also have a reasonable amount of time to digest the information they include before the markets open on Monday. We applaud the work that Arthur Levitt Jr., until recently chairman of the SEC, has done in cracking down on the corporate practice of selective disclosure that has spread like cancer in recent years. Indeed, it has become virtually standard practice for major corporations to guide analysts or large holders to earnings expectations that were intended either to be on the nose or a tiny bit below what the company truly expected to earn. Through the selectively dispersed hints, winks and nods that companies engaged in, speculatively minded institutions and advisors were given an information edge over investment-oriented individuals. This was corrupt behavior, unfortunately embraced by both Wall Street and corporate America. Thanks to Chairman Levitt, whose general efforts on behalf of investors were both tireless and effective, corporations are now required to treat all of their owners equally. The fact that this reform came about because of coercion rather than conscience should be a matter of shame for CEOs and their investor relations department. One further thought while I'm on my soapbox. Charlie and I think it is both deceptive and dangerous for CEOs to predict growth rates for their companies. They are, of course, frequently egged on to do so by both analysts and their investor relations departments. They should resist, however, because too often these predictions lead to trouble. It's fine for a CEO to have his own internal goals and, in our view, it is even appropriate for the CEO to publicly express some hopes about the future if these expectations are accompanied by sensible caveats. But for a major corporation to predict that its per-share earnings will grow over the long term at, say, 15% annually is to court trouble. That's true because the growth rate of that magnitude can only be maintained by a very small percentage of large businesses. Here's a test. Examine the records of, say, the 200 highest earning companies from 1970 to 1980 and tabulate how many of those increased per share earnings by 15% annually since those dates. You will find that only a handful have. I would wager you a very significant sum that fewer than 10 of the 200 most profitable companies in 2000 will attain 15% annual growth in earnings per share over the next 20 years. The problem arising from lofty predictions is not just that they spread unwarranted optimism. Even more troublesome is the fact that they corrode CEO behavior. Over the years, Charlie and I have observed many instances in which CEOs engaged in uneconomic operating maneuvers so that they could meet earnings targets they had announced. Worse still, after exhausting all operating acrobatics would do, they sometimes played a wide variety of accounting games to make the numbers. These accounting shenanigans have a way of snowballing. Once a company moves earnings from one period to another, operating shortfalls that occur thereafter require it to engage in further accounting maneuvers that must be even more heroic. These can turn fudging into fraud. More money, it has been noted, has been stolen with the point of a pen than at the point of a gun. Charlie and I tend to be leery of companies run by CEOs who woo investors with fancy predictions. A few of these managers will prove prophetic, but others will turn out to be congenial optimists or even charlatans. Unfortunately, it's not easy for investors to know in advance which species they are dealing with. 3 suggestions for investors. First, beware of companies displaying weak accounting. If a company still does not expense options, or if its pension assumptions are fanciful, watch out. When managements take the low road in aspects that are visible, it is likely they are following a similar path behind the scenes. There is seldom just one cockroach in the kitchen. Trumpeting EBITDA, earnings before interest, tax, depreciation, and amortization, is a particularly pernicious practice. Doing so implies that depreciation is not truly an expense, given that it is a non-cash charge. That's nonsense. In truth, depreciation is a particularly unattractive expense because the cash outlay it represents is paid up front, before the asset acquired has delivered any benefits to the business. Imagine, if you will, that at the beginning of this year, a company paid all of its employees for the next 10 years of their service in the way they would lay out cash for a fixed asset to be useful for 10 years. In the following 9 years, compensation would be a non-cash expense, a reduction of paid compensation asset established this year. Would anyone care to argue that the recording of the expense in years 2 through 10 would simply be a bookkeeping formality? Second, unintelligible footnotes usually indicate untrustworthy management. If you can't understand a footnote or other managerial explanation, it's usually because the CEO doesn't want you to. Enron's descriptions of certain transactions still baffle me. Finally, be suspicious of companies that trumpet earnings projections and growth expectations. Businesses seldom operate in a tranquil, no-surprise environment, and earnings simply don't advance smoothly. Except, of course, in the offering books of investment bankers. Charlie and I not only don't know today what our businesses will earn next year, we don't even know what they will earn next quarter. We are suspicious of those CEOs who regularly claim they do know the future, and we become downright incredulous if they consistently reach their declared targets. Managers that always promise to make the numbers will at some point be tempted to make up the numbers.